Welcome to Accounting in Focus. Let's take a look at how to handle a special order problem. So here we have on the screen, ABC makes refillable metal pens which sell for $15. They have an accounting firm that's approached them to purchase 5,000 pens, and they want their company name engraved on the pen so they can give them out to clients. And they want to purchase them for $11 each. Now, ABC doesn't normally engrave on pens, so they'd have to buy a special machine for that, which would cost $4,000. But the machine would probably never be used again. So the company has capacity to produce 30,000 units a year, but this year they only plan to make 115. But the company believes that they're on track to do that. So the company's costs are as follows. Direct materials are 3. Direct labor's 2, variable overhead is $330, and fixed overhead is $425 per unit. So their total cost is $1255. Should ABC accept the order? Now, the first thing that I would do is I would make sure that we decide what information is relevant. So if we go back to the questions that we have to ask ourselves whenever doing a special order, first thing we have to ask ourselves is, do we have capacity? Okay, so capacity is number 1. Okay, how do you judge if we've got the capacity to make the order? Well, it says here that the company can produce 130,000 units per year, and this year they're planning to make 115. Okay, so they have an excess capacity of 15,000 units. 130 minus 115 is 15,000 units. This order is for 5,000 pens, which means that they have the capacity to make the order. So check, yes, we've got the capacity. Now the second question is the price high enough to cover the incremental cost of filling the order? AKA, will we make money? Make money. Okay, so will we make money if we fill this order? So now let's see, okay, what is relevant? What information do we have that's relevant to making our decision? Is the price of $15, is that relevant? Well, that is not relevant. So we can cross that out. Okay, there's nobody here that's offering us $15 per pen. What we are being offered is $11 per pen. That is relevant. Is the number of pens they're going to order relevant? Absolutely. We can't figure out if we're going to make money if we don't know how many pens we have to make. Is the cost of the engraving machine relevant? Absolutely. Because if we buy this machine, we're probably never going to use it again. So we have to make sure that whatever profit we make, that it covers the $4,000 for the engraving machine. So yes, that's relevant. Okay. Now let's go down to our variable costs. Is direct materials relevant? Yep, absolutely, because we're going to incur $3 in direct material cost for every pen we make. Direct labor, is that relevant? Yep, because we're going to have $2 of direct labor for every pen that we make. Oh, variable overhead. Again, variable costs are relevant because we're going to incur that cost for every pen that we make. Now what about fixed overhead? It looks like it might be a variable cost, right? Because it's $4.25, but remember, it's fixed overhead. Fixed overhead does not change no matter how many units we make. So if our plan was based on 115,000 units and we're on track to achieve that goal, that means that our fixed costs are already covered. Fixed cost is not relevant. Okay? So now that we've identified our relevant costs, the 5,000 pens, $11 per pen for the price, $4,000 in additional costs, and then our direct material, direct labor, and variable overhead. So now we can start doing our calculation. So first, we've got our price, which is $11. Next, let's calculate our total variable cost. Total variable cost is 3 plus 2 plus 330. So that is $8.30 in variable cost. Okay, all we did is we added these three together. Okay, so $8.30. So my contribution margin is $2.70 per pen. Okay, so now we already know that we've got positive contribution margin. Okay, so if we didn't have to factor in the cost of the machine, then we could say yes, we should take this order. However, we have to make sure we're going to cover the cost of the machine. So in order to do that, now I've got to look at, well, what is the total profit that this job is going to bring in? So I'm going to multiply by 5,000 units. And if I multiply the 270 by 5,000 units, I get $13,500. Okay, so that's my total contribution margin, total CM. Okay, now we've got the cost of the machine that we need to cover, and the machine is $4,000. So we're going to subtract that. And once we subtract that, we realize that we'd make $9,500 off the job. Not too shabby for a special order. So if we accept the order, the company would make an additional $9,500. So we'll say additional profit. Okay, so with that additional profit, should ABC accept the order? Yes. You always want to accept the order if we have the capacity to make it, if we're going to make money, which is a wonderful thing. So we'll put a check mark next to that. Yep, we're going to make money. And the last thing that you always want to consider when you're doing a special order is you want to make sure, will it affect regular sales? Affect regular sales. Okay. Now here, this is for an accounting firm that's purchasing these pens to give out to clients. So it's not like we're selling them to a competitor of one of our other vendors. Okay, this is basically going into an accounting firm to be given away. So will this affect regular sales? Probably not. Okay, so we're okay with that too. Okay, so yes, we're going to accept this special order.